Hi, welcome back. It's been a while since my last session, but in today's session, I'd like to talk about two topics that seem disparate, disconnected, and I've talked about both individually in the past, but I'd like to connect the two. The first is the issue of cash holdings in a company. As many of you are aware, in businesses, most companies hold cash, and we're going to look at the motives for holding cash and why some companies need to hold more cash than others. Indirectly, we're asking the question and trying to answer it: how much cash is too much cash? The second question, if it's a question, is the question of Bitcoin, a currency slash collectible that has taken off like a rocket and is in fact the topic of conversation among a lot of investors. I've written about Bitcoin in the past and I've kind of talked about what I feel. I feel that it's something that I'm not comfortable with as an investor, that it can only be priced, not valued. More about that later. But in this session, I'd like to talk about both cash and Bitcoin connecting. In what way? The success of MicroStrategy, a company that has used Bitcoin to elevate its market cap, has kind of brought Bitcoin to the surface. And what's effectively happened is in a bunch of companies, shareholders have put out proposals at least that the company should take the money it has in cash. We've talked about cash and put it into Bitcoin. And the rationale is a very simple one. Cash earns 2, 3, 4%. Think of how much more money you could have made by putting that money in Bitcoin. I'm going to give away the game. I'm going to argue that for most companies, this is not a good idea, that this opens the door to scandals and corporate governance fiascos. But there's a subset of companies where I think it does make sense for companies to think about adding Bitcoin to what they invest in. So let's start with cash. One of the best ways I can think of illustrating how cash fits into a company is to look at a financial balance sheet. You've seen this before in my other sessions. In a financial balance sheet, you break down a business into what it owns and what it owes and how much equity it has. I'm going to take what a business has, what a company has on the asset side of the balance sheet, and break it into three groups. The first are the operating investments of the company, the business it's in. I'm going to subdivide that into investments already made, assets in place, and growth assets. This is the value attached to growth in your operating businesses. The second grouping is non-operating assets, primarily holdings in other companies, non-operating investments that a company might make. Some of these investments reflect the history of the company. If you're a family group company, these cross-holdings in other companies reflect your history as a company. The third grouping is for cash and marketable securities. These are investments made, at least that's a traditional definition, in riskless or close to riskless investments that are liquid. We'll talk about the motive for doing so, but that's where cash fits into a financial balance sheet. What are the motives for holding cash? In my introductory corporate finance classes, we hardly ever talked about cash because in a world where capital markets are open and accessible, you don't need cash other than for operations. So the primary use for cash in at least my introductory classes was as a working capital item, as a lubricant for businesses. What am I talking about? If you're a retail firm, you need, at least historically have needed, cash in the till when people pay to give them change, essentially cash for day-to-day operations. In fact, many valuation practitioners have rules of thumb on operating cash. McKinsey used to have a rule of thumb that companies need 2% of their revenues in cash. I think that rule is passé. I don't think people use it as much, but that's the first use for cash, as a lubricant for businesses, as part of the working capital for a business to keep it operating. There's a second use for cash, and we need to bring this to the surface. It's as a shock absorber. What am I talking about again? I'm essentially talking about the fact that companies can't anticipate everything that's going to happen to them. That cash can act as a shock absorber against things that happen that put the company's financials in trouble. A recession if you're a cyclical company, drop in commodity prices. So cash operates as a shock absorber. Well, those are the two primary reasons for cash. There's another way for framing cash, and that's in terms of another structure that I like using in my classes, which is that companies go through a life cycle. And at each stage of the life cycle, your cash requirements, the need for cash, there's a different rationale. If you're a startup, pre-revenue or very little in revenues, you need cash to keep going because that cash is what you use to pay salaries, cover R&D, cover reinvestment. As you become a young growth company, your revenues have started to show, but you're still a money losing company and you have negative cash flows. Cash becomes your life preserver. In other words, you run out of cash, you could be in trouble. So, in fact, analysts used to use a ratio called the cash burn ratio to measure the risk of a firm. For young growth, cash becomes a life preserver. As you become a high growth firm, you're starting to make money, but those profits are low, your revenues are growing. Cash becomes a scalar for your business to make your small company into a bigger company. As you approach mature growth, cash becomes something that you use to find new ways of growing, new options for growth. I call it a growth option. If you become a mature firm, you become middle-aged. And like all middle-aged entities, you want to be young again. Cash becomes a youth serum, something used to try to make yourself young again. Most of the time it doesn't work, but you can see the rationale. And finally, in decline, cash becomes something you use to manage your liquidation, to pay off debt, to have an orderly liquidation rather than be forced into a sale where everything has to be sold at bargain basement prices. Lots of different reasons for holding cash. There's one final reason, and that's got to be brought to the surface as well. I firmly believe that if managers are left to their own devices, they will return very little cash to shareholders and hold on to cash. Why? Because holding on to cash gives them power. It makes them sought after by bankers and consultants, and it gives them the power to use that cash to meet their interests, to build empires, to do acquisitions. So lots of different reasons for holding cash, and not surprisingly, they manifest as fairly large cash balances in the hands of companies. So I'm going to start by chronicling how much cash companies have. So coming into July of 2025, here's what I did. I took every publicly traded company in the world. I added up everything they held, remember the breakdown into operating assets, into non-operating assets, and cash and marketable securities. I looked at the aggregated value for those numbers across all companies, for both US and global companies. So if you look at collectively at all US companies, they have $2.4 trillion in cash. That's about 9% of the overall book value of US companies. Collectively, global companies have 11.4 trillion cash, collectively almost 11% of the book value of companies. Clearly, companies have large cash balances. In fact, there's some information in the rest of the breakdown. You'll notice that US companies have a larger percentage of book value coming from goodwill. What does that tell me? Nothing more than the fact that US companies might be more acquisitive. Because remember, goodwill comes directly out of acquisitions. You'll also notice that intangibles at companies are showing up. These are intangibles other than goodwill. That reflects that the growth of fair value accounting, but in spite of its growth, goodwill remains the dominant intangible asset. So with that lead in, let's look at the breakdown of cash holdings by sector. What I've done in this table is actually looked at cash as a percent of total assets, the book value percentage, and cash as a percent of firm value, that's market value of equity plus debt. If you look across sectors, at least on a book value basis, the sector that has the highest cash balance is technology, and about 19% of book value. And that shouldn't be surprising. I mean, technology companies tend to face the most uncertainty. If you think of cash as a shock absorber, it makes sense. If you look at the sectors with the least cash, they turn out to be real estate and utilities. Regulated or fairly stable businesses hold less cash. I've also reported cash as a percent of market value, and there technology companies drop off the map from one of the highest cash holding sectors to one of the lower cash holding sectors. Why might that be? Because technology companies have market values much higher than book value. So again, cash balances vary across sectors for all of the reasons we chronicle for holding cash. I then broke down cash by region of the world. So if you look across the regions, the parts of the world which have the highest cash balances are China, Eastern Europe, and you can look across and if you look across regions, you look at and Latin America. You look across regions and look at why some regions have higher cash balance. I can point to two reasons. One is again uncertainty. Parts of the world like Latin America, where there's a great deal of uncertainty, companies hold on to cash in both book value and market value terms because they're worried about the future. If you look at other parts of the world like Eastern Europe and Russia, in addition to the uncertainty, you have a corporate governance issue, which if you cannot put pressure on managers to return cash, they're going to hold on to cash. Again, reasons for holding cash vary across regions, and you can see cash balances vary across regions. Finally, given my earlier talk about life cycle and cash, I broke down companies based on corporate age, from youngest to oldest. And here the patterns are kind of all over the place, right? If you look at cash as a percent of total assets in terms of book value, I mean, the bottom 5 deciles hold more cash than the top 5 deciles. Younger firms hold on to more cash, but there's no discernible pattern across the deciles. If you look at cash as a percent of firm value, even that pattern starts to get weaker. So the only thing you can draw out of this is younger firms, at least in the aggregate, tend to hold more cash than older firms as a percentage of both book value and market value. So that's a cash discussion. Let's turn to Bitcoin. There is some value in going back to the origin of Bitcoin because it's going to tell us why Bitcoin is designed the way it is and has evolved the way it has. Bitcoin was born in November of 2008 in that paper written by Satoshi Nakamoto, a pseudonym, or for somebody we don't know who it is. But the reality is Bitcoin was born 2 months in one of the worst financial crises in the last century. A crisis created by banks and governments behaving irresponsibly. And we had lost trust. That drives how Bitcoin was designed. It was built on the presumption that you cannot trust institutions. And the biggest innovation in Bitcoin is, of course, the blockchain, which is, and forgive me if I'm getting this wrong, is a way of crowd-checking transactions rather than trusting a bank or a central bank to do it. Now, I've long described Bitcoin as a currency designed by the paranoid for the paranoid, and I don't mean that as an insult. In the world we live in, where everybody seems to be untrustworthy, maybe it's better to be paranoid than the alternative. And over its lifetime, Bitcoin has taken over both the imagination of investors and the pricing has reflected that. This is, of course, the graph that looks at Bitcoin over the last decade. And you can see that it's had ups and downs, but especially in the last 5-6 years, more ups than downs. From less than $400 a Bitcoin to almost 110,000 or greater in June of 2025. And it's that price rise that's driving a lot of the discussion of Bitcoin. And of course, one of the questions I keep getting asked in the valuation space is Bitcoin overvalued? And my answer is you can't value it. And that's not a cop-out, and here's why. In a paper that I wrote on Bitcoin a few years ago, I talked about investments falling into 4 groups. You can have assets. Assets have cash flows, and you can either value them or price them. So businesses, stocks, bonds are assets. You can have a commodity, oil. How can you price oil? Maybe in some macro level, but they're more. How can you value oil? Maybe it's a macro demand supply. Tough to do though. It's more price than value. You can have a currency which cannot be valued. The dollar cannot be valued, but can be priced, an exchange rate based on how good it is a currency, how much it holds its value, how good is it as a medium of exchange, or a collectible. A collectible cannot be valued as well. We're talking about gold and Picassos. There, it's demand and supply that sets it, scarcity being the determinant of supply and desirability driving demand. So the question then is, what is Bitcoin? I know that some of you might not like the rigidity of that breakdown, but it's useful because the starting point for a Bitcoin discussion is, what is it? It is not an asset. Is it a commodity? No. It is either a currency or a collectible. On both fronts, there are some questions that have been raised about how Bitcoin has evolved. 17 years into its existence, Bitcoin has become this great speculative trade, but it struggled on the currency front. It's had some limited success in the Silk Road for illegal transactions, for countries like El Salvador with a failed currency, but it's not taken off the way its advocates had hoped it would. It's something you can use to pay for a pizza or a Starbucks cappuccino. As a collectible, Bitcoin has delivered on one half of the equation. It's scarce because it's limited to 21 million units. But it's also struggled on the other dimension, which is a good collectible holds its value or even increases it in the face of a crisis. Gold is a good collectible. Bitcoin, in contrast, since 2008, every crisis has behaved more like risky stock than like a good collectible. That could change. The bottom line is discussions of whether Bitcoin is cheap or expensive are kind of a waste of time, because if it's a collectible and it's driven by demand and supply, it's entirely an issue of perception. If I'm a pessimist, I might say this is a passing phase, more Beanie Baby than a real collectible, in which case I would never buy Bitcoin. On the other hand, if I believe that Bitcoin is as a collectible that's going to hold on, the demand is going to stay, well, 21 million units, and the demand increases, you could see the price go to $1 million per Bitcoin. So I've never waded into that discussion, because it is going to be entirely in the eyes of the beholder. Now let's talk about what's driving this current push to get companies to adopt Bitcoin. One company has made it, has become this lab experiment. What happens when a company becomes a Bitcoin player? It's a company called MicroStrategy. It's a technology company. In fact, I would argue that many people who bought Microsoft in recent years probably don't even know that what it does or what its software is designed to do. But it started as a tech/software company. And in this graph, I look at its price since 2014. Between 2014 and 2018, doesn't do much. In fact, it lags the S&P 500. And then in the last 6 years, it's kind of especially in the last 4, it's exploded out of the box. And you can see that if you'd bought MicroStrategy instead of the S&P 500, you'd have delivered a lot higher returns for your portfolio. It's been a stock market winner. But that stock market winning has not come from its software taking off. It's come and it's been driven by Bitcoin. In this graph, you can see how the two interplay. I've imposed the price of Bitcoin on MicroStrategy stock price, and you can see, especially in the last few years, it's the rise of Bitcoin that has pushed up MicroStrategy stock price. If you don't believe me, take a look at MicroStrategy's revenues and operating income in the last decade. They've actually declined while the market cap has exploded from less than $1 billion to more than $90 billion. So clearly it's Bitcoin driving MicroStrategy upwards. And along the way, MicroStrategy has had a CEO, high-profile CEO, who's been not just a vocal promoter of Bitcoin, but has converted many of the shareholders in Bitcoin, in MicroStrategy, to believe that he has this capacity to tell when, price movements, that he's a good trader in Bitcoin. In fact, he's been pretty public about his objective of raising equity to buy more Bitcoin. It's at this point at least, I'm comfortable making the claim that MicroStrategy is no longer a software/technology company. It's a Bitcoin SPAC, where you have Michael Saylor as the SPAC promoter, raising cash to buy Bitcoin, and investors are trusting him to make the right trading moves. Again, no critique, no insult. That is the way I see MicroStrategy. Now the question is, should other companies follow MicroStrategy? As a general principle, I don't think so. And here are 5 reasons. One is, if you remember the reasons for holding cash as a shock absorber, as something you use to kind of get through bad times, Bitcoin doesn't deliver on that. If you replace cash, which in spite of all of its sins, its low returns, its low volatility, the value stays pretty stable, with something like Bitcoin, you could see, even if you're a Bitcoin advocate, how much that varies, you don't meet that cash objective. Second, if you're a company which has a good operating business and your value comes from the story you're telling about the operating business, putting your cash into Bitcoin risks stepping on your story. So, and 2 reasons. One is, if I'm an investor and I see you putting your money in Bitcoin and you have a good business story, I'm saying, why are you taking your money and instead of investing in projects or building new software, you're investing in Bitcoin? The second is, the moves in Bitcoin can start drowning out the operating results of your own story, kind of, again, get in the way of your story. Third, when you let companies put your money, and you're the shareholder, money in Bitcoin, you're trusting managers to be good traders. And you know what? Their history doesn't suggest that they're very good at trading, that they can time low point. In fact, the history of managers is that they're terrible traders. They buy high, they sell low. The fourth is, even if you believe that Bitcoin is the place to be, Wouldn't you rather that companies pay the cash out to you and you invest in Bitcoin yourself, that you choose what to invest in, whether it's Bitcoin, gold, Picasso's, or a sports franchise? And finally, opening the door to letting managers invest in Bitcoin is a license for abuse, because who knows whether you can actually track these investments and monitor them, and whether in fact you're going to have scandals that come out of people taking cash out of companies, claiming to invest in Bitcoin, and the money just disappears. So as a general rule, I don't think companies should adopt in Bitcoin, but I'm going to adopt 4 carve-outs. The first is the MicroStrategy case. We have a CEO or CFO that, for better or worse, I'm going to call a Bitcoin savant. They understand Bitcoin, they can gauge its direction, in which case you're essentially investing in the company because you're letting the CEO or CFO time your trades for you. And this is not unique to Bitcoin. I know investors for decades invest in Berkshire Hathaway, which is a holding company, because they believe Warren Buffett was able to find undervalued companies for them. They paid a premium. You're paying a premium for a company because you think the CEO or CFO is going to go out and time Bitcoin trades better. That's the first carve-out. That's a MicroStrategy carve-out. The second is, if you're a company whose business requires that you be in Bitcoin, you might have to hold a cash balance in Bitcoin to cover that. PayPal and Coinbase both have Bitcoin in there as part of the balance sheet, but they need it because they have transactions in Bitcoin. But here's the test. Just as in the Bitcoin savant, the test is, can a CEO keep timing the Bitcoin market with the Bitcoin business? Is the balance you have in Bitcoin proportionate to the kinds of transactions that you do in Bitcoin as a company? So for some companies, your Bitcoin balance reflects your need for Bitcoin to keep your business going. The third is what I call the Bitcoin escape artist. Some of you might be familiar with Mercado Libre, a company that I've told you that I really like, a Latin American company headquartered in Argentina. It's a Latin American online retail company, but the headquarters in Argentina is what I want to focus on. As many of you know, the Argentine pesos is flirted with disaster for the last decade. And if you're Mercado Libre and your currency is the Argentine peso, you're running as fast as you can away from the peso. So if you're a company in a country where you worry about the currency failing, you might hold Bitcoin because it has more stability than your domestic currency. And there's a final carve-out. This is called the meme company. There are some companies whose operating businesses have died, but for whatever reason, they've become meme stocks. AMC and GameStop are classic examples. There's no business story you can tell me to justify the pricing for each company. But for better or worse, they've become the stock that people trade. And as a trading stock, you might say, well, my operating business is broken. I might as well become a full trading stock. So you could argue that stocks like AMC and GameStop going into Bitcoin effectively plays the game. I think it's a very dangerous game, but these companies have thrown in the towel on their operating businesses and become Bitcoin plays entirely. So with those carve-outs, though, I would argue that you need guardrails. First, if you're a company and you plan to do this, you need the shareholders to buy in. You need approval on this front that we're going to be Bitcoin players, and here's why. Second, I think we need transparency about Bitcoin transactions of your company. When you're buying, when you're selling, how much you hold. You cannot hide behind, we can't reveal information about Bitcoin for security reasons. No. And if you claim to be a Bitcoin trader, the Bitcoin savant, then I'm going to track you to see if in fact you are a good trader. You also need some clear mark-to-market rules in accounting. How often do you mark to market? Where does it show up in your financials? So I know if you hold Bitcoin, where to look for it in the financials. Now, if you're a Bitcoin advocate, I know you're pushing for institutional investors and companies to buy into Bitcoin for a very simple reason. It pushes up demand, and with fixed supply, that should push the price upwards. But before you get too caught up in this push, remember that this might be a mixed blessing. Because as you get the establishment to buy in, here are the 3 things that are going to happen. You're going to draw on a very different investor base than the historical traders in Bitcoin, institutional investors, companies, and that's going to change the characteristics of the market. So if you have played this market well for the last decade because you understand the market's going to change. Second, you might be able to get institutions and companies to buy into Bitcoin now. You know why? Because Bitcoin's doing well. But what if Bitcoin halves in its price, as it has done historically? Institutions and companies are sheep. They tend to follow each other. The very same institutions, companies that are buying in today could sell out, and who knows what that's going to do to the volatility of Bitcoin. And the third is, when you get the establishment to buy in, you make yourself more attractive to institutional investors and companies. It comes with a cost. It makes your whatever you've sold to them behave more like stocks and bonds. It's happened to real estate in the 1980s. Real estate no longer is an asset that moves differently from financial assets. Do you want that to happen to Bitcoin? So if you are somebody who's a true Bitcoin believer, I would be more guarded in my trying to get the establishment to buy in. I hope you found this session useful. And as I said, this is not about what I think about Bitcoin's future. It's about whether companies should be putting their cash in Bitcoin. A very different question, and hopefully a very different answer. Thank you very much for listening, and have a good day.